Everybody. So last week I actually got an email from a client of mine and he asked me, how does my plan 3 get taxed? What kind of taxes will I owe on this in the future? So today I just want to address that question. My name is Ethan Miko, the co-founder of Scenic Financial. Please subscribe to my channel for more content like this. I specialize in helping school district employees build better financial lives. So now to answer that question, we have to dig back to what plan 3 really is. And what it is a pre-tax retirement account. So remember that pre-tax retirement accounts mean that we haven't paid taxes on this money yet. So every dollar we have in them, we still owe taxes on. Whether that dollar came from our contributions or it was a dividend or some kind of growth that we got in the account, there still needs to be taxed. So Plan 3, along with every other pre-tax account you have out there, whether they're IRAs or the DCP, will have to be taxed in the future. Now, as far as how much taxes you're going to owe on them, it's going to come down to your income tax bracket in retirement. So Plan 3, you'll be taxed as you pull and spend the money. So remember, if you're going to transfer that money to a different company in retirement, that's totally fine. You only get taxed when you go to take it and spend it or put it in your own bank account. And that's when the taxes are triggered. So it's going to break down to what your income tax bracket is. So for example, if in retirement you find yourself in the 25% tax bracket, then you're going to have to owe 25% of every dollar you pull out of that retirement account. So as you take money off of that Plan 3 account, you're going to be taxed at your highest marginal tax rate. Now, if taxes in the future are higher, which there's a good chance they are, just looking at how the current tax code is written and the fact that all this stimulus money is being pushed out, taxes really have to go off to pay off all this debt. But be careful here, because any distribution you take from that pre-tax retirement account counts as income, and it's going to bump your income level up. So you may bump yourself up into a different tax bracket if you take too much money out at once. So it's important to look at what your income bracket is and where threshold you're at is before you take money out. Because the last thing you want to do is take money out and be bumped up in tax that year and have to pay more taxes on that money. Another thing to be careful of when you take distribution out, because you're going to be increasing your income when you take those distributions, you may end up paying more taxes on your Social Security as well as paying more money for your Medicare plan. And so that's just some basic points on how taxes work on that Plan 3 accounts. Now, if you want to learn how to build yourself a tax-free retirement, so you don't have to worry about any of that, in the description below, there's a link to my free masterclass where I break that down completely for you. Check out this video over here where I talk about it a little bit more and how 403Bs really aren't a great investment. And remember that your future depends on what you do today.